Let's now have a look at learning objective number one. Learning objective number one looks at accrual and cash accounting. So what we're going to look at here is describe how profit is measured and reported under the accrual and cash basis of accounting. Now, cash accounting is easy to understand, right? So, for example, we generate revenues from customers. Customers pay us $50 in cash accordingly. Okay, so we say that $50 cash is our revenues, and then we have to pay for supplies worth $10, and so therefore we treat that as our expense. So I started with 50, I paid out 10, so therefore my profit for the period is the difference between the two, which is $40. This is cash accounting. You simply look at the difference between your cash inflows and your cash outflows to determine what your profit is for the period. But that's not how we report accounting performance. And that is not the basis of how the income statement is constructed. All financial statements that you read that are reported anywhere are based on the accrual basis of accounting. And the accrual basis of accounting looks at when we earn revenue and when we incur expenses, which may not necessarily be related to cash flow. So let me give you an example. Here's my iPhone. I have this iPhone on a Telstra prepaid account. So I'm a bit tight, so I don't have a mobile phone plan because I feel they cost too much. So therefore, accordingly, I have a prepaid plan, which I feel is better value. So I pay for that prepaid plan up front, right? So I pay $30 a month to Telstra, and I get a lot of usage associated with it. So is my expense incurred when I pay my $30? Well, no, it's not, because I essentially have a resource that is available for use when I pay the $30 at the start of the financial period. Now, once I've paid the $30, I can then use the phone throughout the financial period. So when I use it, I of course am using up my prepaid balance and therefore using up my resource and incurring an expense. So this is the difference. What we are interested in accrual accounting is when we are generating revenues, which specifically relates to when we generate and earn those revenues. So we deliver on our obligations to the customer. When we record an expense, we look at where we use up resources associated with generating revenue, which again may not necessarily be related to cash flow. So just like the example I gave you with my iPhone and the prepaid account I have, the expense is not upfront. The expense is when I actually use the resource during the period I've paid for. Now, when we look at recording adjusting entries today, we're going to use exactly the same system that we used last week with the debits and credits and the structure of the transactions that we looked at last week in workshop number 3. So in workshop number 3, we looked at recording transactions in a journal. And the transactions that we record in a journal look like this. So you debit at least one account and you credit at least another account, remembering, of course, the debits and credits need to match because the debits and credits relate directly to the accounting equation and the accounting equation needs to stay in balance. Now, it's very important that at this stage you are up to speed with this coding system, that you can proficiently record accounting transactions. And if you're not at that level yet, then you really need to go along to your tutorial and ask us questions to close any gaps in your understanding. So you can effectively understand the different adjusting entries, which use the same debit and credit recording system that we cover today. So if we look at the rules of debits and credits, these are the rules here. And remember, if I bring out my trusty piece of paper here, which I asked you to write down the accounting equation with the debits increasing the assets and the credits increasing liabilities and equity and vice versa below. The same is shown on this slide here. So you debit to increase assets, you credit to increase liabilities and shareholders' equity, and vice versa to decrease both of those sides. So this is something that you need to remember. The more you practice it, the easier it will come to you. Just like when you're driving a car, the more you do it, the better you get. So if we look at this equation here, this is the basic accounting equation that I showed you last week. There's nothing new here. We're not changing it in any way. So assets equal liabilities plus shareholders' equity. Now, as part of shareholders' equity, I assumed last week that revenues increased that equity and expenses decreased that equity. So if we look on the right-hand side of this equation, I have added revenues and expenses, right? So rather than assuming they are part of shareholders' equity, I've explicitly written revenues and expenses as part of this equation. Now, as I said, this equation is not changing. I'm just providing extra details as to what is included in the equation. Okay, so we know that revenues increase the value of the business for owners, so therefore we add revenues to this side, and expenses decrease it because resources are flowing out, so we deduct it from this side, the right-hand side of the equation. Now, if we go to the next slide, I rearrange this equation using basic mathematics that you have learned in Year 8 if you studied in Australia, so early high school, and I leave the revenue on the right-hand side, and I take the expenses off the right-hand side and add them to the left-hand side, essentially, right? So we add expenses to both sides, so that clears out revenues from the right-hand side and adds it to the left-hand side. So we now have a new way of looking at the accounting equation, which, as I mentioned before, is still the same equation. We've just got some extra detail here. We've got assets plus expenses equals liabilities plus revenues plus shareholders' equity. So why is it important to restructure the equation in this manner? Well, if we go back to the rules of debits and credits, if you want to increase assets, you debit them. You also debit expenses to increase them. If you want to increase liabilities, revenues, and shareholders' equity, you credit them. Remember, the debits always need to equal the credits, and these two boxes are each side of the accounting equation. Now, remember that an easy way to remember the accounting equation is that your assets and expenses need to be funded by something. And they're funded by either, or a combination of, typically, liabilities, so borrowing, revenues, so amounts you receive from your customers, and shareholders' equity, so contributions by the owners of the business. So, as I said, I'll repeat that again, the assets and expenses need to be funded by something, so they equal the value of the liabilities, revenues, and shareholders' equity. And so this is an easy way to remember the structure of the accounting equation. And also you need to remember that debits increase assets and expenses, and credits increase liabilities, revenues, and shareholders' equity. So make sure that if we look at your piece of paper again, you can add expenses to the asset side and revenues to the liabilities plus equity side of the equation. So you can remember those rules. So I would like you to do that right now. So as you can see with my accounting equation, I've added expenses to the right-hand side of the equation, and I've added revenues to the left-hand side of the equation that I'm showing you here. So please keep that in mind. Okay, so if we move on and we look at the steps in the accounting cycle, right? So last week in the workshop, we looked at the first 3 steps, which were recording the accounting transactions, posting them to the T accounts, and then working out what the final account balances were so you could draw up your financial statements. Today, what we look at is the remaining steps, which is the adjusting process. So we need to adjust some of the accounts to bring them up to date in terms of the revenues we've earned for the period and the expenses we've incurred, so we can comprehensively report on what the financial performance of a business is for the period. And we're also going to look at the closing process that prepares the accounting system for the next period. I'm not going to talk about that now. I'll talk about that later on in this workshop. So what's the difference between accrual and cash accounting? So I already indicated to you that cash accounting is all about recording your profit based on your cash flow, essentially. So if you have positive cash flow for the period, that positive cash flow is equivalent to your profit for the period. Now, in the long term, what is the difference between cash and accrual basis of accounting? Well, really not much, because ultimately, if you purchase supplies, if I pay for my prepaid phone account, obviously I use up cash, and under the cash basis of accounting system, which no business uses that reports any results in any publicly available financial report, they will record an expense at the time they pay for that cash outlay. Now, in the accrual accounting system, of course, they don't record an expense at the time of the cash outlay, but they record the expense when they use up that particular resource. And ultimately, the business will use up that resource and recognize the expense at the time they use up that resource and make adjustments at the end of the period to bring it all up to date. And so therefore, ultimately, accrual and cash basis of accounting will give you the same profit numbers over the long term. So then you might be asking, well, why do we go to the effort to actually record adjusting entries under the accrual system? Well, we do that so we can separate performance on a period by period basis, and we can look at how successfully the business has performed for each financial period. Okay, and that was an important characteristic of accounting. It was an important thing that we look at, and we want to evaluate business around how they have performed over a particular period of time. So that is why we need to record adjustments to report on what that actual performance is and how that relates to the financial position of a business at the end of a period. So generally accepted accounting principles require the use of accrual accounting, and that's why you will not find any financial reports that are publicly available, for example, for ASX listed companies that do not use accrual accounting. They all use it, and so to interpret accounting information and to critically evaluate it, you need to make sure you understand how businesses use the accrual basis of accounting.